This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh and this video will be a guide on taxes on shares if you are a New Zealand tax resident. So in this video, I'll be covering the different types of taxes that you could be liable for and also some of the tools that you can use to help you calculate your taxes. So as a disclaimer, I am a chartered accountant, but I am not a tax accountant by profession, nor am I your personal tax accountant. So please do not leave any comments or questions on your personal income tax situation because I won't be able to answer those questions to avoid myself getting into any legal trouble. Always seek help from a tax accountant if you do need help from a tax accountant. This video will purely be for educational purposes only and is not considered tax advice. Now with that out of the way, let's go into the first topic, which is taxes on dividends. Now this is considered the easier part of taxes because whether you're a trader or an investor, you still have to pay taxes on your dividends. So there's three different types of classes of stocks that I'll talk about. So the first one is PI entities. So a PI entity is a portfolio investment entity, and the two most common ones that you might know of are the multi-rate portfolio investment entities, much like the mutual funds that you invest on a platform like InvestNow. And you also have the listed portfolio investment entities such as the REITs or the real estate investment trusts. So your Precinct, your Agosi, those are also considered PI entities. Now these entities are taxed at your prescribed investor rate. Usually when you sign up to platforms like InvestNow, they'll get you to enter what your PIR rate is. And what that does is that it automatically taxes you based on your PIR. PI entities are taxed automatically, so you won't have anything to worry about as long as you've entered your prescribed investor rate correctly. Now you can check that on the IRD website if you don't know whether you've got the right PIR. So moving on to New Zealand stocks, these stocks are taxed at 33% regardless of your rate, all right? And this is done automatically. So when a company declares a dividend, you'll only get 67% of the gross dividend, or in other words, 100% of the net dividend. So what you receive is net because the government has already taken 33% of your dividend. In terms of overseas stocks that pay a dividend, these dividends are taxed at your individual tax rate back in New Zealand. So if you have a personal income tax rate of 33%, then your dividends will be taxed at 33%. And this is done manually, so you will need to add the amounts that you received from these companies into your tax return yourself. Now, in terms of how you can reduce your taxes, there are a few ways that you can do that. So for PI entities, if you have the correct PIR rate assigned, there's no need to include dividends on your return. I did include an asterisk over there because there are some instances where you might want to actually declare your PI dividends in your return. And the reason being is because some of the listed PI funds, so for example, like Agosi or Precinct, they will charge a tax of 28%. So if you have a personal income tax rate of lower than 28%, then you might be able to actually claim back some imputation credits. But if you have a tax rate more than 28%, then it makes more sense not to declare that because it is a final tax after all, and you don't have to include that on your return. In terms of New Zealand stocks, you can claim imputation credits on New Zealand companies on your return. If you're unfamiliar with imputation credits, the IRD has a useful website over here, but basically an imputation credit allows shareholders to receive tax credits with the dividends they receive by allowing the company to pass on credits for the income tax it has already paid. So basically what this means is that the company has already paid taxes on the profit that they make, so you're able to claim that back as a credit for yourself when you pay your income tax. If your income tax rate is less than 33%, then what that means is that you can actually claim back some of the credit. Now I've included here the tax brackets for each income level. So for example, if you earn between 48 and 70,000, your tax rate is only 30%, but remember the government has already taken 33%. So you can actually claim back some of the imputation credits for the 3% difference. If you have income over $70,000 and you have a tax rate of 33%, you'll still have have to declare any dividends that you've received from New Zealand companies on your tax return. The reason being is because you need to declare the dividend received because you might be liable for any student loan repayments. For example, when you have a student loan, you have to pay that off using your income, and that also includes dividend income. So still declare your dividends anyway if you have a tax rate of 33%, even though you won't necessarily get a benefit from the imputation credits. So in terms of overseas stocks, to reduce your taxes on this, you can declare the tax paid to overseas countries on your return, and you only pay the New Zealand IRD the difference. So for US stocks, for example, they have a withholding tax of 15%. So the IRS in the US will take 15% of your dividend. You only get 85%. On your return, you declare how much total overseas income you've received, as well as total overseas tax that you've paid. So as you can see from this example, I have made a total overseas income of $95.25. If my personal income tax rate is 33%, then the tax owing, or the tax that I should be paying, is $31.43. Now, the IRS has already taken $7.95 New Zealand dollars, so the difference that I should pay to the IRD is $31.43 minus $7.95, which means a net tax amount of $23.40. And the last way to reduce your taxes is if foreign investment fund rules applies to you, there will be no need to pay taxes on your overseas dividends on FIF stocks. Now I'll talk about the FIF rules later on in this video because it does get quite detailed and there's a lot to talk about. So I'll talk about that in the later part of the video. And lastly, just to be very clear, starting from the next tax year, there'll be a new income tax bracket for over $180,000 of income. You will get taxed 39%. So if you're watching this video next year, then that is something to consider about as well. Alright, so now with dividends out of the way, let's talk about capital gains taxes in New Zealand. So at the moment, there's no comprehensive capital gains tax in New Zealand, but certain capital gains are taxed as ordinary income. So for example, we have taxes on gains on property, and that is done under the bright line test. And recently in this past week, we've seen the Labour government coming out and saying that they'll extend the bright line test from 5 to 10 years. So we don't have a capital gains tax, but sometimes we'll tax you on your capital gains. So that is how the law works in New Zealand, and the same applies to shares as well. Obviously, the shares is not under the bright line rule test. There'll be another test, and I'll be talking about that in the next slide. What I'm trying to get to on this slide is basically that the taxpayer will need to determine whether the capital gains on their sale of shares are taxable. So now let's take a look whether you're a trader or investor. Trader means that you have to pay taxes on capital gains. Investor means you don't. Alright, so there's 3 criteria here from the Income Tax Act 2007. I've paraphrased these sections a little bit, so if you go to the actual law itself, it'll be slightly different, but I've just changed the wording a little bit to help you make more sense out of it. So the first criteria under section CB3 is whether you've bought the shares in a profit-making undertaking or scheme. So what that means is that there's usually a plan that you've deliberately set out to make money out of shares. Alright. The second criteria under section CB4 is that the shares were bought with the intention of selling them. So the IRD will assess this based on what your intentions were when you originally bought the shares. So if you say later on that you've changed your intentions, you will still be taxed because when you've bought the shares, you were intentionally buying it to make a profit. So the IRD will look at your original intentions when you bought the shares, and if you say that you have an intention to hold for the long term, but then you constantly buy and sell very frequently, the IRD can then say, look, you said you had the intention, but your actions don't agree with that, so then we'll treat you as a trader versus an investor. And lastly, section CB5 is the last criteria, which is that the shares were bought as part of a business that involves dealing in shares. So if you set up a company to buy and sell shares, then you will get taxed as a trader. So to qualify as a trader, you only need to meet one of these sections. You don't have to meet 2 or 3 of them. You just need to meet one of them and you'll be qualified as a trader. So over here, I've created a flowchart to show what type of taxes you might be liable for depending on your situation. So the first step is to look at if any of the criteria set out in the Income Tax Act 2007, Section CB3 to CB5 are met, as we've talked in the earlier slide. If it is, then the profit from the sale of shares is taxable, plus dividend income is taxable. But vice versa, if you've made a loss on your shares, then you'll be able to deduct that against your gains. Another benefit for being a trader is that you'll generally be able to deduct any costs involved with buying or selling shares, such as your brokerage fees. Now, I say that generally because it might not apply to all situations, so if you are a trader and you need clarification, be sure to seek out advice from a tax accountant. So if you believe you haven't met any of the section CB3 to CB5, then next you'll have to consider whether you have more than 50,000 New Zealand dollars on a cost basis or more invested overseas for the entire year. So throughout the tax year, so from beginning to the end of the tax year, if at any one point in time you had more than $50,000 on a cost basis invested in overseas stocks. Now, I do have an asterisk over here as well that excludes most ASX stocks. So ASX stocks aren't counted in there. I'll talk about that a little bit later. But if you have more than $50,000 on a cost basis, then you'll be liable for FIF taxes. All right. So if yes, the foreign investment fund rules apply, plus dividend income on non-FIF is taxable. So if you have any New Zealand stocks, you still have to pay dividends on that, but you won't have to pay taxes on dividends for your overseas stocks that you own. On the flip side, if you don't have more than 50,000 New Zealand dollars invested, then only dividend income is taxable. So if you're an investor and you don't have more than 50,000 invested overseas, you only need to pay taxes on dividends. So that is the easiest way to pay taxes, is be an investor and don't have more than 50,000 invested overseas. All right. So those are the different outcomes. Now let's talk about the foreign investment funds exemptions. So I've talked about when it doesn't apply. So it doesn't apply when you have less than $50,000 New Zealand dollars invested on a cost basis. So this is called the de minimis exception. And the second exemption is that Australian companies, most not all, are exempted and not included in the 50,000 New Zealand dollars cost basis quota. Now you can search this on the IRD website. Just Google IRD ASX exemption list and you type in the ticker and they'll be able to tell you whether or not it is taxable under FIF rules. Now, there are a few other exemptions that I've not included in this list because they are less common. So if you want to make sure or check it out, you can Google IRD's Foreign Investment Fund Rules exemption page, or you can seek out advice from a tax accountant. So there's a few different ways to calculate FIF taxes. I'm going to talk about two most common ways to calculate FIF taxes, especially for shares. The first one is the fair dividend rate. So short form as FDR. Now FDR is calculated as 5% of your opening value of your investments. So that is the beginning of the tax year, so 1st April, plus any quick sale adjustment. So to paraphrase this, a quick sale adjustment is required if the investor buys a certain overseas stock and subsequently sells that overseas stock within the same year. So this number, the quick sale adjustment, is calculated as the lesser of the peak holding amount or the quick sale gain. Now I won't go into these two methods because this video will get too long, but you can find more information on IR 461. So just Google that number and it'll show you IRD's guide to calculate FIF rules for the fair dividend rate. The second method that I'll be talking about is the comparative value, so the CV method. Now the CV method is calculated as taking the closing value plus gains minus the opening value plus cost. All right, so I have the definitions over here, so I won't bore you. You can pause this page to digest the information. Now, in terms of deciding which rules that you want to apply, you can actually apply the FDR method or the CV method depending on which method gives you a better result. So for example, if the FDR gives you a lower taxable income versus your comparative value, then you can actually declare your taxes on your tax return based on the FDR method. Or if CV method is lower, then you can obviously choose the CV method. But the exception to that is that you can only apply one method to all of your foreign investment funds or your overseas stocks. You can't selectively choose which rules to apply to which type of stock. So you have to apply it consistently, but you can change it year on year. So in terms of the tools that can help you calculate FIF, because I know it sounds a little bit complicated, IRD has a free FIF calculator online. So you enter all your stocks that you have in there and you can, IRD will help you calculate how much taxes you are owing. The second method is to use ShareSite. Now ShareSite is the method that I personally use, and they'll help you calculate your FIF taxes, your trading profit if you're a trader, as well as any taxes that you need to pay on your dividends. So ShareSite is my favorite method, and I'll show you how to use ShareSite just in a moment. And the last method, as well, as always, if you find taxes too complicated, seek help from a tax accountant. So now I'll go through ShareSite very briefly to show you how you can use that to prepare your tax returns. So here is ShareSite. Here is my fictional portfolio. So I've just randomly created this portfolio as an example to show you how you can use the different reports to help you with your taxes. But basically, if you're new to ShareSite, what you can do is you can import all of your holdings in here, and it will calculate for you your historical performance, your value, your capital gains, dividends, currency returns, and total returns. So if you're new, what you can do is you can select import from broker, and you'll automatically import all your data from your broker into ShareSite, and you wouldn't have to manually add in each individual trade. So you'll be able to import all of the information on your holdings as well as your trades from all of these platforms. So it does have a few big ones over here like Hatch, Direct Broking, ASB Securities, Stake, Interactive Brokers. So there's a lot of New Zealand brokers in there. It doesn't have Sharesies yet, so hopefully that will come very soon. So if you want to import all your trades from Hatch, you just click Hatch and they'll give you all the information to get started on that. All right, so if I come back to my portfolio, I'll be able to generate a few different reports. So for example, I'll show you the all trades report just to show you what I've entered into this fictional portfolio. So this is all the trades that I made for 2020. So if I go back to 2015, this is all the trades that I've manually created on this fictional portfolio. As you can see, I bought and sold Meridian. I've also bought and sold some Tesla, and I've also bought and sold Hallenstein's Glassons. So I'll show you how you can use this tool as a trader. What you do is you go into report and you can go traders tax report. So as a trader, you obviously get taxed on your gains and you can deduct any losses that you make. So this report over here shows us the amount that you need to pay for this financial year. So what you can do is you can click current financial year and it'll show you all the income that you've made and the losses that you've made to declare on your income tax return. So in this case, it's $19,300. As you can see, the loss that I made on Meridian is $27,000, and that offsets against the gains that I've made on Hallenstein's as well as Tesla. So what I'll need to do then is on my tax return, I'll need to include $19,300 on my tax return. Now, if you're not a trader, then you don't have to worry about that trader's tax report. If you're an investor, you'll have to pay taxes on your dividends and interest payments. So what you do is you click over here, and what that does is that it calculates all the dividends that you've received locally in New Zealand as well as overseas. So in this case, I've received a $3,600 dividend from Hallenstein's as well as $552.46 in overseas income. And they've also calculated for us the resident withholding tax, the imputation credits, so that you can easily enter this into your tax return to get that tax credit back. And it also calculates the non-resident withholding tax of $97. So this is taxes that the overseas country has already taken, and that is a tax credit to you in New Zealand. So I've talked about that earlier in the video. Now, if I do have more than $50,000 invested in overseas companies, what I can do is I can go into this FIF report, and it helps us calculate the tax liability as part of the FIF rules. So what they'll even do for you is that they'll even calculate how much at a cost basis you actually own at a point in time. So in this case, my peak balance at cost is $50,934, and that is above the $50,000 that is stated in the FIF threshold. So in this case, I do exceed the threshold for FIF taxation purposes. What they'll do is they'll calculate it using two different methods. So as I mentioned earlier in the video, it is the fair dividend rate method as well as the comparative value method. So under the fair dividend rate method, they calculate my overseas income to be $3,191, whereas with the comparative value method, my overseas income would be $64,181. So as I mentioned earlier, you can basically choose the method that gives you a lower income amount. So in this case, I'll selectively choose the fair dividend method and only need to pay taxes on $3,100 instead of $64,000. So this is probably one of the most useful tools on ShareSite, especially if you do have over $50,000 invested in US stocks or overseas stocks, because it helps you calculate what your cost basis is, and it also calculates how much taxable income you have under the two different methods. So ShareSite is definitely a useful tool to help you calculate taxes. It also shows you other useful things like your performance report to track how well you're doing against a benchmark. So I highly recommend ShareSite, and it is the tool that helps me, sort out my taxes so I don't have to worry about that come tax time. All I need to do is just generate a few reports and I'll be on my way. So if you do decide to sign up with ShareSite, I do have a referral link down below. You'll get 4 months for free if you sign up with an annual plan. If you don't want to pay for a plan, you can also try out their free version, although there is a 10 holdings limit. This will give you a good feel on how ShareSite works. If you do use the link below, I will get a small kickback, which will greatly support this channel. So hopefully this video will give you a good idea on what taxes you need to pay from an educational perspective. This is not tax advice, and if you found this helpful, be sure to share it with other people who you think will benefit from this video. If you enjoyed today's video, be sure to hit like and subscribe, and until next time, take care.